Stock market crashes are a part of investing. We can't tell you when the next crash is coming. Stock market crashes are inherently unpredictable. If we could predict the next crash, we'd prevent it in some sort of minority report for investing. At some point, an unforeseen event will cause a big market decline, and you'd better be prepared when it happens. Ways you can get ready for the next stock market crash are by understanding your investments and why you chose them, allocating funds appropriately for your investment goals, and planning what you want to accomplish during the crash. With today's market being so highly priced, we have a lot of investors out there scared of a market crash or a recession. A lot of people are worried about their precious stock portfolio crashing and being left with half of what they originally had. Now in the video, I'm going to explain why a recession is a positive thing for those smart investors out there. First, let's explain what a recession is. A recession is a period of economic decline that lasts for at least a few months. The one common trait that all successful bear market investors have is that they buy high-quality companies, not necessarily the stocks that drop the most during the crash. The S&P 500 has always eventually recovered from every recession, but the same cannot be said for many lower-quality companies that do not have the cash flow and balance sheet strength to survive and make it through to the next economic expansion cycle. Now, what you'll normally see in a recession is those stocks you so carefully invested in decline as well. So what do we do in a recession? First, of course, we wipe our tears with our sleeves and start thinking about our investing approach. Did we invest in these stocks because they were a quality company trading at a good price? Do we understand the company that we invested in? Well, I hope so. If you didn't, then go review that company again. Do you still think it's a good company? If so, it's not trading at a cheaper price. So perhaps the question might be asked, why not buy more in this company? That's the exact question you should ask. And for those who did invest in a quality company that they understood the value of, then you should definitely ask yourself that question. When that company was more expensive, you bought it. So why don't you buy more of it now that it's cheaper? Here's the scenario. You've wanted a Ferrari ever since you were a kid. The Ferrari was selling for a $200,000 price tag, but you just couldn't quite afford it. A few months later, you look at the price of the Ferrari and it's now selling for $120,000. That's a 40% discount, makes you beat your bottom dollar. You're going to buy that Ferrari. Every smart investor out there knows that a stock market crash means a sale. It means stocks are getting cheaper and thus our eyes are more open to investing in that stock. Now, what's the one thing you need when investing in a market crash? Dollar bill? Cash money in the bank. If you think a salt market crash is coming, then make sure you have money to invest in shares when it does happen. Our good friend Warren Buffett has $100 billion of cash on hand at the moment with his firm, Berkshire Hathaway. Now the big question is, does he have this much cash on hand because he thinks the market crash is coming, or is it simply because he's getting so much money to invest in that he can't spot cheap, quality companies to invest in? I'm not 100% sure, to be honest. The one thing that I would like for you guys to take from this video is that when a recession, market crash or depression does decide to show its face, that is not necessarily a bad thing. Stocks have gotten cheaper and it is a better time to invest than when it was more expensive. Obviously, I hope this video provides you guys with some helpful information for what to do in a bear market. What to do when the market's crashing. If you properly prepare for a stock market crash and have a plan in place, now's the time to execute the plan. If you've never experienced a stock market crash before, you may be hesitant to actually do what you plan to do as you feel fear or anxiety perpetuated by the ongoing crash. That's important to make note of and remember for the future. Every crash is different, but you can get a better feel for them each time one occurs. Take the time to assess your investments instead of engaging in panic selling. Make sure your thesis remains intact and isn't impacted by any economic or political events that may have triggered the market sell-off. If not, it may be time to dump the stock and free up cash for better opportunities. Note that it's very rare for a market crash to be caused by something that completely nullifies your original investment thesis for a company. Once the market's recovered or on a clear path toward recovery following a crash, it's an opportune time to assess how you performed. Did you stick to your plan or did you let fear guide you? Did you sell stocks you should have kept because not much fundamentally changed? Conversely, did you keep stocks you should have sold because the investment thesis is no longer true? If you had trouble following your plan, you likely want to adjust your asset allocation to reduce the negative impact of a stock market crash in the future. If you had no problem sticking with what you wanted to accomplish, you might consider adjusting your asset allocation to be more aggressive and putting more of your money into stocks in order to maximize your long-term returns. A stock market crash is an opportunity to learn and grow. If you're prepared for their inevitability, you can become a successful investor. So if you have found this video helpful, please like, share and subscribe our channel.